Hello and welcome to the show. Let me start off by saying that I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. It is December 1st, 2021. And being December, people are starting to think about taxes and end of tax year and that kind of stuff, preparing their financial situation for taxes. With regard to MMTLP, they should be announcing a dividend before December 28th, they said, or before December 31st, right? Because that's when the Metamaterials Torchlight Preferred Shares is expected to announce a dividend if they are able to sell the lands. So, interestingly enough, let me do a shout out to rollerpigeon. She's got a really good video on qualified dividend rates versus capital gains rates. So she talks about selling the MMTLP shares versus actually taking the dividend and what the implications are. And she's got a good video. Check it out. I'll provide a link below in the description section. One of the best websites that I've seen about qualified dividends, and that explains it really well, is the Fidelity website. There'll be a link provided below. But anyway, they state that with qualified dividends, you wind up getting the same tax rates as long-term capital gains, and that's a much lower tax rate than your ordinary income tax. So Fidelity states that the rates that you could wind up paying are 0, 15%, 18.8%, and 23.8%. Now that's for federal taxes only, of course, right? So if you know anything about capital gains tax rates, you know that they're usually classified as either 0, 15, or 20%. But in a few recent years, there's been an additional tax, which is about 3.8%, which is an extra 3.8%. And that's called the net investment income tax. It's also called the unearned income Medicare contribution tax. And a lot of people just call it the Obamacare tax because it was it was meant to finance Obamacare, right? And so the Obamacare tax comes in at different thresholds based upon what your filing type is, right? If you're single or head of household, it comes in at greater than $200,000, right? If you're married and filing jointly and you make over $250,000, that's when it kicks in, that kind of thing. So we can't state exactly where it kicks in because it depends on your filing status and and there's a different income level for that. Similarly, for the capital gains tax rates, depending upon your single or head of household or married jointly or married separately, then depending upon what your filing status is, you'll be paying either 0%, 15 or 20% based upon your income level and that filing status, right? So here's a little table that actually describes what they are. These are as of 2021, by the way. So in order to get a qualified dividend, you have to hold it for a particular period of time. And for stocks, there's two different holding periods. They're either 61 days or 91 days, depending upon whether it's a certain preferred share or if it's a regular stock that has a regular dividend. So we'll see. So I put a little table up, right? So there's, depending upon the type of stock, if it's a preferred stock, you might have to hold it longer than if it's a regular stock. Right? So you have to hold it for either 61 or 91 days, and during a window of opportunity, we call it a period of time when you have to hold it, that lasts either 121 or 108 or 181 days. That's the length of that period, but it can start either 60 days before the ex-dividend date or 90 days before the ex-dividend rate. Now that sounds confusing, so I made a little graphic. Oh, by the way, these shares have to be held in an unhedged state, meaning you can't sell them, you can't short sell them, you can't buy puts on them, you can't buy calls. They have to be held unhedged. Okay. And I made a little graphic over here which shows what the window is, right? So there's the ex-dividend date. That's a date that that's a date that you had to have owned the stock at, and if you if you didn't own the stock before that date, if you didn't hold the stock on that date, then you will not get that dividend, right? But if you held it on that date, then you will get that dividend, right? And that's called the ex-dividend date. So the window of time, which is the period of time that you have to hold the stock, you have to hold the stock consecutively for a number of days, right? But that number of days has to be within a certain window, and that window of time is based upon the ex-dividend date. So, and it's basically half the amount of time before and half the amount of time after, right? So generally, if you have to hold the stock for 61 days, if you've held it for 60 days before the ex-dividend date, and on the ex-dividend date, that's your 61 days, and you're good to go, right? If you have to hold it for 91 days, then there's the ex-dividend date, and if you've held it for 90 days before that, and on the ex-dividend date, you're good to go, right? You might have to hold it for a day or two longer after that just to be safe, and then sell the stock after. And generally, I don't really think about the ex-dividend dates because I basically just hold on to the stock forever, right? But I mean, it's good to know. So the IRS also talks about this, and they go into much more detail than Fidelity, which only talks about the qualified dividends. But they're not as easy to read, obviously, because they go into all the ifs, ands, or buts, right? So so they've got a good website on this. It's topic number 404, dividends, and they break them up into 3 different categories. So I'll go over each of the 3 categories in detail, actually. So first off, there's dividends, which are called ordinary dividends, and they are taxed. They're called ordinary because they're taxed as ordinary income tax. Most dividends do not qualify as ordinary dividends because most dividends wind up in the qualified dividends region or so. But ordinary dividends are things like real estate investment trusts, where you'll just wind up paying ordinary income tax on that. Okay. Now, most dividends are actually coming in as possibly qualified dividends, and they're taxed at the lower capital gains rate, right? This is what we want for the MMTLP shares because, we'll be paying less taxes on those. Now, it's possible that they could be classified as a return of capital, which is a little bit different, right? A return of capital, the IRS says that distributions that qualify as return of capital are not dividends, and that the company, in general, the return of capital is used to reduce the cost basis of your stock, meaning whatever you paid to buy the stock, it will reduce that overall amount, okay? So if the company doesn't have any accumulated earnings or profits in that year, it may get qualified as a return of capital now, okay? And once your adjusted cost basis of that stock has been reduced to 0, meaning whatever you paid for the stock, if you get the money back as a return of capital, and it is the amount that you paid for the stock, so that reduces your cost basis down to 0, any further non-dividend distribution is a taxable gain, right? Taxable capital gain. So that means that you get stuck into the capital gains category, and there's a short-term capital gain and a long-term capital gain. Now with the short-term capital gains, you get taxed as ordinary income tax. At the long-term capital gains, you get taxed as the long-term capital gains rate, which is what you want, right? The ordinary income tax is a much higher tax rate. Fortunately for you, the brokerage firm will give you a 1099 dividends and distributions form. And the payer of the dividend, meaning Metamaterials, they'll correctly identify the type of dividend, and it has to be based, and they can only identify it, right? It has to be based upon criteria that the IRS has come up with for them. So, so this will be taken care of in your 1099 div, and you'll get the information there, okay, as to what type of dividend this is. So this is an overall overview of what qualified dividends are, the period of the holding period, and what the tax rates would be, right? So and it includes the extra 3.8% Obamacare tax or net investment income tax, whatever you want to call it. So this gives you a quick overview of everything. So, that led me to ask a question. Suppose the MMTLP dividend is much greater than the price of the MMTLP shares. What happens then? Now, we know that the MMTLP shares were priced at anywhere from 10 cents all the way up to $3 and plus, right? But most of the time, they spent around, I don't know, above $1 and below $2, right? We'll say, right? So very few people were, actually wound up, very few people got it at 10 cents per share, right? Because there just wasn't a lot of volume there, right? When the price went up, it only spiked for a short period of time at over $3 a share, and there was a large volume spike at that time too, but it didn't last for long, right? So most of the time that the shares were actually traded, it was between $1 and $2. So that's why I asked this question. If the MMTLP dividend is much greater than the price of the MMTLP shares. And the reason is that I did a calculation on what the MMTLP dividends could be. It's based upon the rollerpigeon's method of calculating the dividend for oil prices. And it's based upon oil prices, gross revenue, the value of oil in the ground, what the torchlight revenue interest is, how much barrels of oil we expect is actually in the ground, what the corporate tax rate is, and the underwriting fee, right? So you do the math, and there's anywhere between $26 to $47 per share of dividend if the price of oil is about $80 a barrel. Right now, the price of oil is lower, so it's $70 a barrel, but we still expect it to be pretty high, right? So if you get a dividend anywhere in this price range, that is significantly higher than what you might have paid for MMTLP. And if you didn't pay for the MMTLP shares and you received the dividend, then your cost basis is zero. So this is much higher than zero as well too. So what happens then? So if you get your 1099 div, and it says it's an ordinary dividend, then you're paying ordinary income tax. I suspect it will not be. I suspect it will likely be the qualified dividend, and if that's the case, then the one thing you do want to do is make sure you hold that stock, the MMTLP, for the required number of days, and you make sure you hold it unhedged. Don't sell the stock. Don't buy puts. Don't buy calls. Don't do shorts with it, because if you do, then it won't fit under the qualified dividend rate, right? It'll fall through the cracks then at that point. If it gets qualified as so about that holding period. So we know that the Series A preferred shares came out on August 19th. Series A preferred shares then got transferred to being MMTLP shares. But if you had the Series A preferred shares, August 19th is the day that you got it, right? Now, the MMTLP shares, they came into existence and first started trading on 2021 October 7th, right? So if you bought it when it first came out, right, then, and you held it all the way till then, till the dividend date, what would happen? You have to hold it for either 61 or 91 days. And if the ex-dividend date is December 28th, 61 days back from then is October 28th, which fits within the time period of which you could have bought it. But if you have to hold it for 91 days, that goes back to 90 days back is September 28th, which means you couldn't have bought it if you didn't have it already. So what happens then? That means that if you bought MMTLP shares, just make sure that you hold it past the ex-dividend date and make sure you hold it for at least 91 days in order to get the qualified dividend rate, right? That's what you want to do. I suspect it's probably the 91 days because it's a preferred share. MMTLP stands for Metamaterials Torchlight Preferred. So there's a good chance it could be the 91-day holding period. If it gets qualified as a return of capital, well, I don't think it'll be this, but if it does, then you wind up essentially falling down the rabbit hole of short-term capital gains tax, and I'll show you why that is. Right? The basis of the MMTLP is, let's just say the basis is near zero or close to zero. Right? It could be $3, it could be $1, it could be $2. It's whatever you bought it at, or it's whatever you received it at. If you received it as from the Torchlight preferred shares, your basis is basically zero at that point. And now once the adjusted cost basis of the stock has been reduced to zero, and if it's already zero, it's been reduced to zero, right? Then any further non-dividend distribution is a taxable capital gain. That means anything above whatever it costs to reduce your basis to zero is a taxable capital gain. And because MMTLP did not exist before, for 1 year, it only came into existence on those dates that we state, it has to fall into the short-term capital gains section. So as a result, MMTLP winds up becoming a short-term capital gains if it gets classified as a return of capital. Right? So I don't suspect that will be the case, but if it does, that's where it winds up. So let me talk a little bit about selling MMTLP. If you sell the MMTLP shares and you don't get the dividend, let's say, then you wind up having to pay short-term capital gains tax, which basically means you're paying ordinary income tax. And as we know, ordinary income tax is higher than the long-term capital gains rate, which is what you would get with the qualified dividend if you were to hold it properly, etc., right? The nice thing about qualified dividends is, unlike actual capital gains taxes, you don't have to hold them for over 1 year, in order to get that long-term capital gains rate. You only have to hold it for either 61 or 91 days within the specified period, which is either plus or minus 60 days or plus or minus 90 days from the ex-dividend date. Right? So there you go. So the qualified dividends are a way to get the lowest possible tax rates. Okay. For references, these are the places to check out. There's a Fidelity website, the IRS website. There's also another website called Qualified versus Ordinary Dividends, and it's from the smartasset.com. I would check them out. They have an excellent breakdown. Also, don't forget to check out the rollerpigeon's video where she talks about qualified dividends versus capital gains taxes. It's worth a watch. Just FYI. And that concludes my video about dividends and the tax implications and MMTLP. Okay. Again, I'd like to state I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. Goodbye.